Forget the headlines about interest rate cuts for a second. While everyone is arguing about whether the Fed will cut rates again in December, they are missing the real story here. Quietly behind the scenes, the Federal Reserve is making a monumental shift in its housing policy. And no, this isn't about a tiny quarter-point rate cut, this is about them systematically walking away from a key part of the housing market they've propped up for 15 years. In this video, I'm going to show you the proof straight from the Fed's own documents and break down what this massive under-the-radar shift means for every single homeowner and homebuyer in America. So for years you've been told a simple story: when the Fed cuts interest rates, your mortgage gets cheaper and buying a home gets easier, and for years millions of Americans have been sitting on the sidelines, just waiting, praying for that relief. You've been watching Jerome Powell press conferences, tracking inflation reports, all for the sign that the financial pain is about to end. But what if I told you that you've been watching the wrong hand? What if the Fed, like a master magician, has been focusing all of your attention on the spectacle of a rate cut, while its other hand quietly dismantles the very system that has kept mortgage rates from flying to the moon? Well, this isn't a theory, it's happening right now. The proof is hiding in plain sight, in their own policy statements, and the effects are about to ripple through the entire American housing market. Stick with me because I'm going to connect the dots here and uncover the hidden truth about the Fed's great escape from housing. So let's be honest, the American dream of owning a home feels more like a nightmare for most people right now. Prices are stubbornly high and mortgage rates have made monthly payments feel like a second job. The common wisdom you hear everywhere is just wait for the Fed. Once they cut rates, the experts say the affordability will come back. And on the surface, it looks like they are trying. Just recently, at their October 2025 meeting, the Federal Reserve cut its main interest rate, bringing the rate paid on reserve balances down to 3.9%. That's the second cut this year, a clear signal they're trying to ease the pressure. The headlines cheered and a lot of homebuyers thought this is it, relief is coming. But this is the great distractions. Believing that these small cuts to the federal funds rate are going to save the housing market is like believing an eyedropper can put out a forest fire. It means you're not even looking at the right game. The federal fund rate is a short-term rate for overnight bank loans. Mortgage rates are based on long-term bonds and they are influenced by a much bigger, more powerful force, the Fed's own balance sheet. For over a decade, the Fed wasn't just influencing rates, it was actively propping up the housing market in a way most people never saw. It became the market's single biggest customer, and now while they distract you with these small headline-grabbing rate cuts, they're quietly walking away. They're ending a 15-year experiment, and the hit to the housing affordability is going to be deep and long-lasting. Those rate cuts are a smokescreen for a much bigger policy shift that's happening right under our noses. So to understand what's really going on, we have to pull back the curtain on the Fed's secret weapon, its $9 trillion balance sheet. I know it sounds complicated, but the simple version is this. After the 2008 financial crisis, the Fed did something radical to save the economy. It basically printed money to buy up financial assets in a process called quantitative easing, or QE. They bought trillions of dollars in government bonds, but more importantly for our story, they bought trillions of dollars worth of mortgage-backed securities, or MBS. What's an MBS? Well, just imagine thousands of individual home mortgages, maybe yours, your neighbors, all bundled together into one giant package, like a financial lasagna. The package is then sold off to big investors like pension funds or the Federal Reserve. By becoming the world's biggest buyer of these mortgage bundles, the Fed created a massive guaranteed demand for them. And as basic economics tells us, when the demand is off the charts, the seller doesn't have to offer a great deal to attract a buyer. In the mortgage world, that meant they didn't have to offer high interest rates. Think of the Fed as a whale in a swimming pool. When it jumped into the MBS market, it displaced so much water that it artificially pushed down the level for everyone else. The mortgage rates for Americans, for years this fire hose of Fed money kept mortgage rates at historic lows, fueling a housing boom. It was a massive direct subsidy to the housing market. Then inflation came roaring back and the Fed had to slam on the brakes. They started hiking interest rates, but they also had to deal with their giant balance sheet. They announced a program of quantitative tightening, or QT, with the goal of letting up to $35 billion a month in MBS simply mature and run off the balance sheet. But the plan hit a snag. The whale tried to get out of the pool but found itself beached. Because the Fed hiked rates so fast, mortgage rates shot up. And when mortgage rates are high, anyone with an ultra low 3% rate from 2021 isn't moving or refinancing unless they absolutely have to. Homeowners were locked in with no one moving, those mortgage rates weren't getting paid off, and the Fed's MBS holding were barely shrinking. The Fed was stuck, holding trillions in mortgage assets it clearly wanted to offload. This brings us to the huge change that happened just recently, the one that isn't getting the headlines because everyone focused on the tiny rate cut. This is the proof of the quiet abandonment. Buried in the Federal Open Market Committee's implementation note from October 29, 2025 is one key sentence. You can look it up on the Fed's own website. It states that starting on December 1st, 2025, principal payments from the Federal Reserve's holding of agency debt and agency mortgage-backed securities will be reinvested in treasury securities. So let me translate that from Fed speak. Until now, the money Fed got back from paid off mortgages was at least in theory still part of the housing finance system, but starting December 1st, that stops. Cold, every single dollar that comes back to the Fed from a mortgage will no longer be recycled back into the housing. Instead, it will be used by government debt treasury securities. This isn't a tapering, this is a formal systematic redirection of funds. The Fed has officially hung a closed for business sign on its MBS window. The single biggest buyer of mortgage debt for 15 years is now explicitly taking its money and going elsewhere. So what does this mean? Well, it's simple supply and demand. With the biggest buyer gone, who will fill the void? Private investors, banks, pension funds, foreign governments, but unlike the Fed, they are not buying MBS to support the housing market, they are buying them to make a profit. And to get them to buy, mortgage lenders will have to offer a sweeter return. How do you offer a high return to investors? You charge a higher interest rate to borrowers. That's you. This is already showing up in the data. Financial analysts are talking about a widening of spreads between MSB and treasury bonds, which is a technical way of saying mortgages are getting more expensive compared to other debt. Precisely because the Fed safety net is being pulled away. The Fed is using the distractions of small rate cut to hide the very real consequences of a much bigger action. They are quietly, methodically, and indefinitely abandoning the roads as the primary backstop for the American housing market. Okay, let's bring this all home. What does this all mean for you, whether you're trying to buy or you already own? Well, first, for home buyers, you've been told to watch the Fed's main interest rate. You need to stop. That's now a secondary factor. The brutal truth is that even if the Fed slowly cuts its main rate, your mortgage rate might not fall with it. It could stay stubbornly high or even go up as the market adjusts to the Fed walking away. Think of it like a shower with two dials. For years, the Fed had the MBS purchase dial cranked to hot and the interest rate dial set to cold, giving you a comfortably warm shower. Now they're turning the interest rate dial a tiny bit warmer, but they're slamming the MBS purchase dial all the way off. The water is about to get a lot colder. Even if one dial says warmer, the bar to enter the housing market just got significantly higher. Now for current homeowners, the implications are just as serious. First, if you're sitting on a mortgage rate under 5%, that lock-in effect is about to get even stronger, crushing housing supply as no one wants to sell. The golden age of refinancing is over. Second, your home value is tied to the demand from new buyers. If this policy sidelines a generation of buyers by keeping rates elevated, it directly hits demand for your property. It could lead to a long period of stagnation where your home's value just goes nowhere. Let me put this in concrete numbers. On a $500,000 house, pundits might say a quarter point Fed cut should drop your mortgage rate from 7 to 6.75%, saving you maybe $85 a month. But they're missing the other side. The Fed abandoning the MBS market could easily add a quarter point or more of upward pressure on mortgage rates. That wipes out the benefit of the rate cut complexity. You're left exactly where you started or worse. So I want to ask you, are you seeing this in your local market? Or are you a buyer who's been waiting confused by all the conflicting signals? Let me know your story in the comments below. And if you want to stay ahead of the hidden market shift and get the truth about what's really driving the economy, make sure you subscribe to this channel and I'll see you guys in the next video.